Return on investment, also called return on capital employed, is equal to profit before interest, tax, and dividend. Interest, tax, and dividend upon upon capital employed. Capital employed into 100. Okay, and I'm just going to simplify this formula. Okay, ROC is much better and more precise, but ROI, ROC is one and the same, is equal to profit before interest and tax upon capital employed into 100. And the reason I don't bother with dividend is because dividend is a payment made after tax. So the fact that it is before tax and before interest means dividend also has not been paid. Anyway, what I have in the question, okay, what's being given to us in the question is net profit after tax is 3 lakhs and tax amounted to 1 lakh. So if I want, okay, you think of it like this. We had profit before tax. From that, we subtract tax. We get profit after tax. But there is a step before any of this under expenses. Okay, so we have to start with, if you have to start with revenue, okay, and whatever you subtract your expenses, one of those expenses is interest. Okay, they categorize it as financial costs, finance costs. Okay, and the details would be disclosed in the notes to accounts. Anyway, so interest comes under expenses. We take total expenses, subtract from revenue or total income, whatever it is, and we get profit before tax. And then we subtract tax to get profit after tax. Okay, so if they're telling us the profit after tax and net profit after tax 3 lakhs, that is year. The tax is 1 lakh, that is year. But the interest, okay, interest also has to be included and added back. So it's not just going to be 1 lakh plus 3 lakhs, it be plus whatever the interest is. And shareholders funds is given to us, 10% debentures is given to us, current liabilities, current assets, non-current assets. Okay, so the only debt is 8 lakhs, 10% of which is going to give us 80,000. Okay, so the profit before interest, tax, and dividend is going to be 80,000 plus 1 lakh plus 3 lakh. Okay, and that is 4,80,000. 4,80,000 divided by capital employed is equal to share capital plus reserves and surplus plus long-term borrowing plus long-term provision. Long-term provision is not mentioned. Debentures is a form of long-term borrowing. Shareholders funds is given to us, and shareholders funds is nothing but share capital plus reserves and surplus. Okay, so basically we are going to add shareholders funds and 10% debentures. Adding it up, we get 24 lakhs, and that we multiply into 24 lakhs multiplied into 100. And you all, I think, are in a position to solve this on your own. Okay, and do not use a calculator. You are not allowed a calculator. I'm going to say 24 ones are and 24 twos are. Okay, and now let's see. We have 4 zeros here, 4 zeros here. Okay, and 1 0 here, 1 0 here. So our final answer is 20%. All right, so fairly straightforward. Any doubts, feel free to message in the comments. And as always, please like, share, and subscribe. Thank you.